Welcome back, everyone. By now, I'm confident that you already understand all the key concepts behind cryptocurrency trading. As we mentioned earlier, there are two main types of funding rate arbitrage strategies. The first one is spot versus perpetual arbitrage, and the second is perpetual versus perpetual arbitrage. In this lesson, we're going to walk through the spot versus perpetual arbitrage setup step by step. This method is the more basic and beginner-friendly version. Many people talk about it over the internet. So I'll first demonstrate the entire setup process, then discuss the advantages and disadvantages, and finally, share some personal experience along the way. The main concept behind this strategy is to create a delta neutral position between a spot trade and a perpetual futures trade on the same coin. We are not trying to profit from price movements. Instead, we make money from the funding payments generated on the perpetual side. Let's begin by visiting coinglass.com. Click on accumulated funding rate and set the period to the last 30 days. Here, you can filter the exchanges you want to compare. In my case, I mainly use MEXC and Bitunix for arbitrage. And in general, the more exchanges you are registered with, the more arbitrage opportunities you will be able to find. On the spot market, you are naturally long the asset. And also, spot trading does not support leverage. So if you buy one Bitcoin on spot, you are holding one Bitcoin outright. To keep the position delta neutral, the perpetual side must be a short position with the exact same size. This is how the price movement cancels out, allowing you to focus purely on earning funding. Now let's walk through a real demonstration. At the moment, I found a coin called Zen that looks suitable because its funding rate has remained consistently positive. I hope that you can find other coin which meet my criteria. Even though spot versus perpetual arbitrage isn't my preferred strategy, mainly because the ROI is too low and the capital requirement is very high. I will still show you the correct setup process for learning purposes. After the demonstration, we'll discuss in detail why this method seems popular online, but in reality, isn't the most efficient way to earn money. Okay, now let's move on to the actual setup. First, open MEXC and go to your wallet. At the top of the screen, you will see a button called Spot. Click on Spot, and this will bring you to the spot trading section. Buying a coin in the spot market means you truly own the asset. So once you enter the spot trading page, search for the trading pair Zen/USDT. Before you continue, make sure you already have some USDT inside your spot wallet. Otherwise, you won't be able to buy anything. Let's also talk quickly about fees. On MEXC, the maker fee is 0%, and the taker fee is 0.05%. This means if you want to save on transaction fees, you should always place a limit order instead of a market order. In this example, we want to invest 80 USDT on the spot side. So when we enter 80 USDT into the total field, you will see that we can buy around 5.71 Zen. Since we want a delta neutral position, we must short the exact same amount on the futures side, around 5.7 Zen. Now switch to the futures page in Bitunix and set your leverage to 6 times. Set the margin mode to be isolated. I recommend keeping leverage between 5 and 7 times because using higher leverage brings the liquidation price much closer and increases your risk. With 6 times leverage, you only need around 13.8 USDT to open a short position big enough to fully offset the spot position. Remember, both position size should be the same on 2 exchanges. In theory, the perfect arbitrage setup would be to buy the spot position and open the short position at exactly the same time. But in real trading, that is almost impossible. If both sides are limit orders, the price moves too quickly to opposite direction, and you will often miss one side. That is why, in practice, I always place a limit order on one exchange, and as soon as that order is executed, I immediately place a market order on the other exchange. This keeps the price difference small and keeps your position delta neutral. Now here's a question for you. Which exchange should we use for the limit order so we can enjoy the maker fee discount? Take a moment and think about it. The answer is MEXC. MEXC has a maker fee of 0%, while Bitunix charges 0.016% for maker orders. So to save fees, we place the limit order on MEXC. Once the limit order is filled on MEXC, we immediately place a market order on Bitunix to open the short. You might ask, why not also place a limit order on Bitunix to save fees on both sides? The reason is simple. Price moves very quickly. If you spend time adjusting a limit order on Bitunix, you may miss the chance to short at the same price as your spot entry. If the price moves even slightly, your delta neutral structure breaks and you take an immediate loss due to slippage. And there is another important point. The funding rate right now is 0.05%, which is equal to the taker fee. This means that just one funding cycle is enough to cover the cost of the market order on Bitunix. So, when we think about the slippage risk, there is no real benefit in waiting for a limit order there. We will talk about the best timing to entry A arbitrage in our future lesson. That is the correct and realistic way to execute a spot versus perpetual arbitrage setup. Every time you set up an arbitrage position, make sure you fill in and select every field correctly on both exchanges before you begin. The market can move very quickly, and your goal is to execute both sides of the trade as close together as possible. If you hesitate or need to adjust settings midway, the price may change, and that can cause slippage or break your delta neutral structure. So always prepare everything in advance. Double check your order size, your leverage, your direction, and your settings. Once both sides are ready, you can submit the orders quickly and smoothly. Now let me walk you through the detailed steps for setting up a spot versus perpetual funding rate arbitrage position. Before you do anything, make sure that the coin symbol on both exchanges is exactly the same. One exchange must be the spot market and the other must be the perpetual futures market. Next, check whether you have enough USDT in both exchange wallets. You will need USDT on the spot wallet to buy the coin, and you will also need USDT on the futures wallet to open your short position. If not, use the internal transfer function. After that, review the transaction fees on each exchange. This helps you decide which side should be the limit order and which should be the market order. The first order you place should always be a limit order, because limit order always has a smaller exchange fee. That's call maker fee. And the second order should be a market order. Do not use market orders on both sides to avoid being charged the taker fee on both exchanges. When you are ready to buy on the spot side, enter the total amount of USDT you want to use and look at the quantity of the coin you will receive. The quantity is important because the short position must match it exactly. Now switch to the futures exchange. Choose isolated margin mode and set your leverage to somewhere between 5 and 7 times. This leverage range keeps your liquidation price at a safe distance and the best use of capital. Select market order, then switch to quantity mode and enter the exact same quantity that you are buying on the spot side. Go to the nearest decimal allowed by the system. Press open short. A confirmation screen will appear. Review the margin and quantity carefully, but do not press confirm yet. Leave the confirmation screen open and wait. While that screen stays open, return to the spot exchange. Read the current market price. Press last to pull the latest traded price, then enter a bidding price at the bottom of the queue. So your order will enter the queue as a maker order. Do not enter a price that is too close to the market price. Otherwise, the order may execute immediately and be charged as a taker fee. If you're new to trading, you might feel a little confused about which price queue you're supposed to look at when placing your order. Don't worry, it's actually very simple once you understand the colors. On the spot market, when you are buying, the buy button is green. So you should look at the green price queue. That's the list of bidding prices where other buyers are placing their orders. These green prices represent the buyers waiting in the queue. This is the area you should reference when you're placing a limit buy order. On the other hand, when you're opening a short position in futures, the button is red. Because you are selling first when you short, you need to look at the red price queue, the list of asking prices placed by sellers. So just remember this simple rule. Green for buying, red for selling. Follow the color, and you will always know which price column to look at. Once you're satisfied, press the buy button. You should see your order appear in the queue with a green indicator. Open your active orders tab and slowly move your bidding price closer to the trading price. But again, do not go too close and never input the trading price. Keep a distance of about 3 to 5 price levels and wait for the market price to come to you. This is how you secure the zero fee maker execution. Keep watching your pending order closely. The moment the spot order is filled, switch back to the futures exchange and press confirm immediately. Since it is a market order, your order will be executed right away. And that's it. You have now successfully completed the setup for a spot versus perpetual funding rate arbitrage position. After you finish setting up your spot versus perpetual funding rate arbitrage, it's a very good habit to double check that everything was executed correctly. The first thing you should do is go to your order history and review the transaction fees. Make sure the spot side used the maker fee and the future side used the taker fee as expected. Next, go to your open positions page and look at the unrealized profit and loss on both exchanges. If your arbitrage setup is correct, the profit and loss should offset each other. They may not cancel out perfectly to zero, but the amounts should be proportional. If one side is showing a small loss, the other side should be showing a similar small gain. For instance, if the spot are losing 10 USDT, then the future side should earning about 10 USDT. Once you confirm that the two sides balance each other, you no longer need to worry about price movement. Your position is now delta neutral, which means price swings will not affect your overall result. From this point on, you simply collect the funding rate, cycle after cycle. Lastly, I want you to take a look at the estimated liquidation price on the short side. Because we are using leverage to open the short position, the futures exchange will always show an estimated liquidation price. This number tells you the exact price level where your margin will be liquidated and your position will be forced closed by the exchange. If the coin price rises all the way up to that liquidation level, the exchange will liquidate your short position. Now, if the price continues to move upward afterwards, your spot position will earn money, that's fine. But what if the price touches the liquidation price first, triggers a liquidation, and then suddenly drops sharply, even lower than your entry price? In that situation, your short position will be liquidated. You will lose your margin, and your spot position will immediately suffer a price loss. This is bad situation, exactly what we want to avoid. We are not here to gamble on price direction, and we definitely do not want to pay a liquidation fee, which is usually a few % of the entire position size. That is why we must set a proper stop loss and take profit on both sides. The purpose of setting these levels is simple: to prevent liquidation and to make sure both sides close together at the same time. First, check the estimated liquidation price on the short side. In this example, the liquidation price is 15.512. To avoid liquidation, we want the short position to close before the price gets anywhere near that level. So instead of using 15.512, I set the stop loss at 15.43, which gives about a 0.5% buffer. This extra price buffer protects us in case the price spikes upward very quickly. On the other hand, the stop loss price for the future side also becomes your take profit price for the spot side. This way, both positions will exit at the same time. Since the spot side has no leverage at all, even if the price drops a lot, the spot position will never be liquidated. The short futures position will cover the loss on spot as the price drops. So the stop loss on the future side is enough protection to keep the whole setup safe. Now let's input the stop loss. On the short side, set your stop loss to 15.43. Then switch to the spot exchange and set your take profit at the same level. Click sell, then choose stop limit. For both the trigger price and the limit price, you can enter 15.43 and set the amount to 100% of your Zen holdings. If you want to reduce the chance of paying taker fees, you can also enter a trigger price slightly lower, such as 15.33 and a limit price of 15.43. And that completes the full setup of the spot versus perpetual funding rate arbitrage. It may feel a little complicated the first time you do it, so I recommend starting with a small amount. After a few attempts, once you become familiar with the process, you can increase your position size confidently. I have summarized all the steps in these slides. Pause the video and think about it. Now let's talk briefly about the ROI of this strategy. Using Bitcoin as an example, the accumulated funding rate over the past 30 days is around 0.64%. Since there are 3 funding cycles per day, that works out to an average of 0.007% per cycle. If Bitcoin's spot price is 94,800 USDT and you buy 1 BTC on spot, you must deposit the full 94,800 because spot trading has no leverage. To hedge this with a delta neutral short position on the futures side, you need around 15,800 USDT in margin at 6 times leverage. If the funding rate stays the same, you will earn about 7,200 USDT in a year. However, your total capital locked inside this strategy is 110,600 USDT. Earning 7,200 on that amount gives an ROI of only about 6.5%. To be honest, that is not very impressive. US government bonds already pay around 4% APY with far lower risk. So from a pure risk to reward perspective, spot versus perpetual arbitrage is not especially attractive. In the next lesson, I'm going to introduce another arbitrage strategy called futures versus futures arbitrage. This one is my personal favorite. The setup is very similar to what you've just learned, but the ROI is much better and the capital requirement is much lower. I'll show you exactly how it works in the next session.